Core inflation in the U.S. rose 2.9% in July, slightly above June. It's the measure the central bank will use when deciding on rate cuts. Let's get to this and other things going on in the markets with Michael Green, Chief Investment Strategist at Simplify Asset Management. Thanks for joining us.
Oh, it's always a pleasure.
What's your read on that core number?
Well, my read on the core number is unfortunately that it is largely composed of lagging and imputed components. So that core dramatically overstates the housing component, the shelter component, which is already quite large in the US CPI data. We know that's composed of lagging information. And unfortunately, as a result, the data comes in hot on a continuous basis, but continuing to decline. The underlying features of inflation have responded to tariffs. We will absolutely see tariffs impact the affected areas in the United States. But the overall story in the United States continues to be one of decelerating inflation. And if we properly measure that, it becomes very, very clear that the Fed is too high in its interest rates.
Okay. The target, of course, is 2%. Do you think the Fed will still be focusing on jobs over inflation when making that decision next month?
I think they will, but the jobs themselves have significant issues. We've seen continued restatement. The payroll data and the income data that we're receiving, unfortunately, is actually imputed from the non-farm payroll data, which we know is inaccurate, largely as a function of the birth-death model, which attempts to estimate the number of new businesses and jobs that are being created in the United States. The net impact of that is that we will see these numbers revised lower. The Fed should be paying very close attention to that. My hunch is that they are still very focused on claims, which is starting to rise, and we are seeing weakening in the labor markets, but it's far behind the numbers that we would have historically expected. And again, there's a change in the economy with the growth of the gig economy. If you drive for Uber when you lose your job, according to the government, you're not unemployed. You certainly feel unemployed, and you feel the stress associated with it, but that's not what the data says yet.
Okay, so talk to me about how much of what is going on, especially with the numbers out today, is tariff related. What are you seeing hit by the tariff specifically, industry-wise?
Well, I shared with you a couple of charts that are hitting the components of the sentiment on inflation. And importantly, the University of Michigan inflation data today showed expectations of longer-term inflation starting to retreat. That is a byproduct of people basically deciding the worst case scenario was not in place, right? So we weren't going to see 20 or 30% inflation tied to 200% tariffs on China. What we are ultimately going to end up seeing in this data is that we'll follow the inflation numbers lower. That's how it behaves. People react to what they have experienced and what their fears are in the past. Unfortunately, the Fed is going to be much slower to respond to it. So we'll likely get our 25 basis point cut. And then we're going to have to pause again, unless the data deteriorates significantly, in which case Elliott Waller will be right, and the Fed is going to be behind the curve yet again.
So were there certain industries, however, that you picked out from the new numbers that were tariff related?
Well, there were some that were tariff related, and then there are others that are actually quite comical. So one of the metrics that was a key contributor to the rise in PCE inflation is what's called portfolio management services. Portfolio management services, ironically, is just the S&P 500. When the market goes up, you're quote unquote paying more for your portfolio management services because you typically are paying on a flat fee. That's one area that highlights kind of how silly the data has become. The stock market goes up because we're no longer worried about inflation. Therefore, that translates to inflation. In other areas where we're really starting to see the tariff impact are in areas that you mentioned, the auto space. We're seeing a rise in secondary vehicles. We've also used vehicles. We're also seeing a fairly significant rise in areas like utilities, where AI spending is starting to pressure the power prices that people are paying. We're seeing increased demand for electricity. That's certainly not helped by the shortages that are created by tariffs or the uncertainty that are associated with tariffs. So the net result is that this is very much like the period around COVID. We just have really uncertain data, and I don't envy the Fed trying to make decisions in this environment.
September, we know, is typically quite a volatile month on the markets. How should investors position themselves ahead of that?
Well, it's interesting because when you talk about September being volatile, it's well known for that. The only other months are January, February, March, April, May, June, July, August, November, October, November, December that are also volatile. So I always advise people to not think about the next month, but instead to think about what you are trying to accomplish with your objectives. Overall, I think people are ignoring the very positive returns associated with inflation-protected bond investments. Those yields are extraordinarily high relative to history. I would suggest that the bonds themselves, because I'm very sanguine about the inflation picture, represent opportunity. But until the Fed begins to move, people are just not going to believe that it is ultimately happening. And so despite the fact that bonds have actually represented an attractive real return for the past couple of years, people are still very scared to flow back in there. We see this in the flow data. I would encourage people not to ignore it.
Michael Green, I have to leave it there with you. Michael, Chief Investment Strategist at Simplify Asset Management. Thanks for your time.